As this video is being released on Valentine's Day, I could have come up with a tenuous link about love or relationships or something, but instead we're going to talk about something far sexier: capital gains tax planning. Saucy. Okay, last week we went over the basic rules of capital gains tax, how it all works. But like any set of rules, there are planning angles that you can consider to minimize your exposure to this tax. Obviously, they're all legit, HMRC sanctioned methods. There's nothing shady going on here. But let's put 5 minutes on the clock to the left here. Say a quick thank you to my friends at 7 Investment Management for continuing to sponsor the show. And let's crack on. Now, the first planning angle is called an InterSpousal Transfer. I alluded to it last week. Everybody has an annual capital gains tax allowance. That's the amount you can gain in any 1 year before you pay tax. Now, if you make use of your spouse's allowance too, then you're doubling the amount you can gain in any 1 year. So let's say you hold some money in a fund and you want to sell it for a gain of £20,000. Ordinarily, you'd be paying capital gains tax on the excess of that gain over the annual allowance. Here, as I speak towards the end of the 2019-2020 tax year, that would be an £8,000 taxable gain after you've taken off the £12,000 allowance, which it is at the minute. That allowance changes every year, so check what it is in the year that you're watching this. Now, if you transferred half of the fund shares that you own to your partner, it needs to be a legal partner, by the way, so spouse or civil partner. If you do that before you sell them, then your gain of £20,000 will be split between you, 10 grand each. And as that falls below the annual allowance, this year anyway, then no tax will be payable at all. Pretty cool, huh? Simply give some stuff to your partner, sell it, and use both of your annual allowances. Simple stuff. Be careful though. I had one client couple who did this, and they did it on a property where he had owned that property for ages and lived in it for quite a while before renting it out. They got married quite late. She never lived in that property. Now, without seeking advice from either me or an accountant, he transferred half the property to her name to take advantage of her annual allowance. Exactly what I'm talking about here. But unfortunately, because she'd never lived in it, she didn't get the residence relief that he did. Net result, an unexpected tax bill of, wait for it, £75,000. That's gotta hurt. Second thing that you can do to plan around capital gains tax is to offset your losses, if you've got any, of course. So let's say you've got two funds, and one of those has done really well, soaring away to give you a tasty gain, but another one has lost money. Well, by realizing the gains and the losses, you can offset one against the other. Even better, you can claim for losses made up to 4 years after the end of the tax year in which they're made, and you can offset them against future gains. It doesn't all have to happen in the same tax year. You do have to let HMRC know of the losses though, and you do that through your tax return. So offsetting losses against gain, useful little angle. Worth mentioning, I always banging on here about multi-asset funds, kind of portfolio funds where everything is done for you. The main reason for that is because I'm a very lazy investor, and so they're perfect. But another benefit of these funds over the alternative of, say, building a portfolio yourself is that any changes made within the fund are not liable to capital gains tax. You only pay tax potentially when you sell out of your shares in a fund for a gain. The fund itself will be rebalancing as it goes, keeping things tip-top for you, and you haven't got to worry even for a second about the tax man as it does that, because it's all within the fund. No CGT for you. But that does raise one important point, and you need to be aware that as you go along in your investing journey, you need to be locking in gains as you go. So imagine you've been going on your merry way, investing regularly, maybe adding lump sums now and again into your multi-asset portfolio. And then 20, 30 years down the line, you get to the point where you want to start drawing some big lump sums out of it. Well, chances are by then, you're going to be sitting on some pretty hefty gains, right? And that could get problematic. But you can help yourself by locking in gains as you go along. It's not difficult to do, it just takes a bit of thought and, as always, being intentional about things. So let's say you sit down a year after you started investing and your portfolio has made a £5,000 profit, right? You don't need the money out, so you might just think, well, you just let it run. But ideally, what you would want to do is to realize those gains by selling your fund, right? The gain of $5,000 is within your annual allowance, so you've got no tax issues at all. Then you can either keep the money in cash within your investment account for 30 days, or you can invest in a different fund for 30 days before switching back to your original fund. Why would you do that? What a weird thing to say. Well, the rules say that if you rebuy shares in the same fund within that 30-day window, then the trades cancel each other out essentially, and you've achieved nothing for capital gains tax planning purposes. Just remember, if you hold the money in cash, you're going to be out of the market for a month, and you might lose out on any upside Of course, at the same time, you'll avoid any downside, bit of a flip of a coin. But if you invest in a similar but different fund, you'll still be in the market, and that all works fine. You're just making a switch. One into another fund for 30 days, and then, if you want to, back into the original. Just remember that when you do switch back to the original fund, that trade itself will give rise to a gain or a loss. You need to keep good records so that you don't inadvertently go over the annual allowance as you're trading in and out. One way to get around the 30-day rule, of course, is to sell out of your fund and rebuy it immediately inside your ISA. In fact, most of us just need to use ISAs across the board, because it's just the easiest way to avoid capital gains tax. There is none inside an ISA. But there are times, of course, when that might not be appropriate. Maybe you're investing within a trust or a company, or, you've got quite a lot of money and you've already used your ISA allowances. Right, quickly, because we're already over time, you can invest any gain made into an enterprise investment scheme, and that delays you having to pay the capital gains tax. I'm not going to go into detail on that because we're already over time, like I say, but this is a mechanism. It's a product, really, which offers you certain tax perks in return for investing into smaller companies in the UK. Of course, they're smaller companies, so they carry a higher risk of failure, and so your money is more at risk than, say, in a conventional investment. That is the price of the tax breaks. If you go to the Meaningful Money website, click on the Learning Center and do some searching, you'll find more on EISs and how they work. So there you go. Some basic planning angles for capital gains tax this Valentine's Day. Maybe watch this back with your Valentine and see where the evening takes you. Have a good weekend. I'll see you in next week's 5 Minute Friday.